Good evening. Chief guest, Dr. Patrick Ndroge, ladies and gentlemen, all protocols observed. It's a great pleasure to welcome so many new and familiar faces to this, our third annual public lecture on financial inclusion. I'm David Ferrand. I'm the director of FSD Kenya, which promotes and supports this annual lecture series. FSD Kenya was established by Kenya's development partners and the government of Kenya to support the development of financial inclusion in Kenya. Current development partners are the UK's Department for International Development, the Bill and Melinda Gates Foundation, and the Swedish International Development Agency. Now, given that our role is to promote the development of financial inclusion in Kenya, it might seem a strange question for us to ask, just what do we mean by financial inclusion? There's no doubt that financial inclusion has come out of the shadows into the mainstream. It is now supported by a huge number of sources, from statesmen, from presidents, to the Secretary General of the United Nations, even to royalty. There is a consensus that financial inclusion is a good thing. And in Kenya, we have made great strides in technology generally. But let me continue. Can people at the back hear me? Good. Let me continue then. So we have made great strides in financial access. Now something like 3/4 of all Kenyans are able to access financial services. But with this extraordinary progress that's been made in the last decade, we feel that it's an opportune time to ask, just what do we mean by financial inclusion, and what's its worth? And one thing that we feel sure about in FSD is that if financial inclusion is to be worth anything, it's got to add value to the people, to the businesses who it reaches. But this lecture is about asking some pretty foundational questions about how that could be achieved. This evening's very distinguished guest lecturer is Professor John Kay. I can think of few people better qualified to help us address this existential question for us than Professor Kay. He is a long and distinguished academic career spanning the London School of Economics, Oxford University, and the London Business School. He has been involved in a very wide range of policy roles, advising governments directly, chairing committees, and heading the UK's Institute for Fiscal Studies, one of the UK's leading economic think tanks. Beyond his role in academia and public policy, he's had a career in business, establishing his own economic consulting firm and serving on the board of many leading companies. He is also a prolific writer, having written 14 books and numerous learned articles and more journalistic pieces. He is currently a columnist for the FT, and I think it's fair to say that many readers of the FT eagerly anticipate his columns, myself among those. Now, one of his books is the reason that we were so keen to have him talk to us this evening. It's called Other People's Money, and I think it frames beautifully the debate that I think we need to have in Kenya. And let me not steal any of Professor Kay's thunder by telling you anything about it, but suffice it to say, it is, I think, probably one of the most insightful critiques of the financial system that I've ever read, and that's the view I'm not alone in holding. the reviews worldwide have formed a similar view. So the format for this evening is Professor Kay will give us the guest lecture. Then our chief guest, Dr. Duroge, will respond and make some remarks about the lecture, and then we will have a question and answer session. So it gives me very great pleasure to introduce Professor Kay.
The idea that after 5 days in Kenya, I was very grateful in particular to FSD for organising the visit and for the range of experiences that has included. And there have, in the course of this week, been 2 events that I would regard as defining moments. One was on Monday, when I was taken on field visits, and we went out to look at several small holdings, and then we visited a community savings group in one of the slum districts of Nairobi. Second was on Wednesday, when I went to CNBC, and you will all be familiar with what CNBC is. It starts with the ludicrous screen that is a display in reception, that is the CNB screen, with a ticker tape endlessly going along the bottom, and the split screens in between, conveying an impression of irresistible, unstoppable, important activity. And that preceded an interview in which it was very clear within a couple of minutes that the interviewer and I were essentially at cross purposes. For me, financial inclusion meant how could we go about meeting the needs of the people I visited on Monday, the smallholders, the people in the community savings group. For the interviewer, it was how could we use modern technology to sell financial products to poor people. That's one meaning of financial inclusion. It's not the one I want to favour today. But it actually poses, and I think that dichotomy poses, the choices which this country faces as it moves towards being a middle and hopefully in due course higher income country. Is what you are trying to do here to move on a trajectory as fast as possible, to be part of the Anglo-American world of finance that has been created over the last few decades? Or are we trying to develop institutions, primarily domestically, that will actually meet the needs and the growing, developing needs of the people whom I was talking to on Monday? I framed that choice in a sufficiently provocative way that you will be rather clear on which side of that divide I'm going to come down. But I want to start this lecture by saying a little bit about why, even if the Anglo-American model were readily available to you, it is not one you should want to follow. When I talk to people in London, people who don't work in the financial sector, and there really are quite a lot of people in London who don't work in the financial sector, believe it or not. When I talk to them, they often ask me, what do people who do work in the financial sector actually do? You see the lights burning in office blocks late into the night. You see the huge skyscrapers in the City of London and its annex at Canary Wharf. And the answer I give when they ask me, what do these people do, is to an extent that almost defies belief. What they do is they trade with each other. Let me give you 1 or 2 examples to make that point. We all know that the total volume of trade in goods and services has expanded a great deal in the last 50 years. But the total volume of trading in foreign exchange markets is around 100 times the total volume of trade in goods and services. For every Kenyan shilling that is transferred into pounds to make a to make a transaction about imports or exports, 100 times that volume occurs in the foreign exchange markets. A company called Spread Networks has recently built a telecoms link through the Appalachian Mountains. The purpose of that link is to reduce the time it takes to transmit data between Chicago and New York from 7.3 milliseconds to 6.6 milliseconds. Just to give you an idea of what that means, none of us in this room can react in any time as short as 10 milliseconds. Of course, these devices are not providing information to humans, they're providing information to computers at each end, which are trading with each other. And the irreducible physical limit to the time it could take to transmit data from Chicago to New York is 4.3 milliseconds, which is the time it takes light to travel from Chicago to New York. We haven't quite got there yet, but with a good deal more expenditure, we probably will. What is this for? People ask. What is the purpose? How does it serve the needs of the non-financial economy? It's a good question, and it's the outcome, as CNBC is, of a process of what I and others have described as financialization over the last 40 years. The way in which finance has developed, become more complicated, and expanded greatly in size and in remuneration. It's the world of finance that has changed from this is banking as it used to be. And even when I was a schoolboy in Edinburgh in the 1960s, banking was a career for the boys in my class who weren't going to get good enough grades to go on to decent universities. They would join the Bank of Scotland or the Royal Bank of Scotland, and if they were reasonably diligent and honest, in 20 years' time they would become bank managers, and in 40 years' time they would retire with a pension. By the time the Bank of Scotland and the Royal Bank of Scotland went bust in 2008, they were run by much cleverer people with MBAs from leading business schools around the world, who managed these banks not just worse, but much worse than the rather dull boys in my class who had enjoyed playing golf with their customers. It's the process by which banking moved from that world to this world. It's happening slowly. No, that's happened too fast. Can we go back? Can we go on one? You won't want to miss this one, so it's worth waiting for them to bring it up. That's it. This is a plaque which was sold by the London liquidator of Lehman Brothers in 2008. I've been trying to find out who bought it, but I haven't succeeded so far. It was opened 4 years before Lehman failed by Gordon Brown, then Chancellor of the Exchequer, and in due course to be British Prime Minister. And this is a cut of Brown actually at Lehman, opening the offices. Next, please. Sound.
Style of leadership meant he was admired and feared in equal measure.
Dick took the floor like a statesman, and he proceeded to deliver this fearsome attack on short sellers, the people who were depressing Lehman's share price by being short the stock. And he, rather to everyone's surprise and mystification, he said,
"If we get this right today, hope it will squeeze some of those shorts. And squeeze them hard. Not that I want to hurt them. Don't get that, please, because that's just not who I am. I am soft, I'm lovable. But what I really want to do is I want to reach in, rip out their heart, and eat it before they die."
Dick Fuld also had an insatiable appetite for profits, with or without fava beans.
Well, we know how that particular saga ended, and we know what the damage the end of that particular saga inflicted on the world economy. Many people take the view that instability is endemic in financial markets, and we cannot avoid instability if we have to have a financial system. It's worth looking back, and I think when we look at the experience of Kenya, it is particularly useful to look back on the economic history, of how the financial system developed. Can we go back again, please? Can we go back to the one after Gordon Brown? That's it. Thank you. This is a brief history in one slide of financial instability. And you can see the story as far as developed countries is concerned. From the Industrial Revolution at the end of the beginning of the 19th century, you see across the 19th century a gradual increase in the incidence of financial crises. At the beginning of the 20th century, it accelerates, and that culminates in the greatest of all financial crises, the Wall Street crash of 1929 and the banking failures that followed that particular event. But you'll also notice that after that period, we go through an era of quite extraordinary and unprecedented financial stability. Essentially the period from the end of the Second World War to the beginning of the process of financialization, which I've described. But as financialization took place from the 1970s, you see a steady increase once more in the rate of financial crisis. There is this brief plateau round about the beginning of the century, which some people rush to call the Great Moderation. It didn't last for very long because it ended in the crisis which we've all seen, the global financial crisis, which took place in 2008. Next, please. And this is a story of what has happened to inequality in developed economies. You can see a pattern where across the first half of the 20th century, in the 4 countries I've taken on this slide, Britain, the United States, France, and Germany, you get a pretty marked decline in inequality. That plateaus out in the 1970s, and in Britain and the United States, it's reversed. In the United States, spectacularly so, with the result that at the end of that currently, the share of the top 1% and top 0.1% in total income in the United States is actually higher than it was at the end of the Gilded Age a century earlier. The rise again in Britain is not so extreme, but it's nevertheless true. In France and Germany, you don't get the same kind of increase, but in France and Germany, you do get a leveling out of the previous trends. So financialization has had very substantial effects on the wider economy in terms of financial stability and in terms of the distribution of incomes. I hope I've said enough to suggest that you might want to hear an alternative point of view before saying you in Kenya want to go down this Anglo-American route and you're looking forward to an era in which there will be a CNB screen in every hut in Kenya. I want instead to ask, what is it that we need finance for? Because let's be clear, although lots of brickbats are thrown by other people at the financial sector, modern economies need finance. There are no cases of successful economic development on a sustained basis without an effective financial sector. But what is it exactly that we want finance to do? Next, please. I believe we want finance to do 4 things. Firstly, and most importantly of all, we need a financial sector to operate a payment system. Everyone from the smallholder in the outskirts of Nairobi to the people who were in the audience at the opening of Lehman Brothers headquarters, every one of them needs a payment system to pay their bills, receive their incomes, manage their finances. And of course, one of the reasons that makes one particularly interested in coming to Kenya is the way in which Kenya has been a pioneer, not just among emerging economies, but around the world in terms of the development of payment systems. The rest of the world is now catching up, and even in Britain you can now bank on a mobile app. But the payment system is the utility of finance. It's the area of finance in which most people who are employed in banking work. Most bankers are not fat cats receiving telephone number salaries. They're ordinary people doing clerical jobs in the back offices and branches of banks. The payment system is also the area of finance which is most vulnerable to digital disruption. We've already seen a large part of that. But as with a great deal of digital disruption, I suspect we haven't seen anything yet. And I'd be pretty confident in 20, certainly in 50 years' time, that our children, our grandchildren, our great-grandchildren will find it extraordinary that we went around with folding bits of paper in our pockets in order to buy goods and services, and will probably find it pretty extraordinary that we held things that used to be called bank deposits. I hope they'll also have technology that is a bit more stable than this one appears to be, but we'll see if we... Right, I think we're getting there. The second thing we need finance to do is what I've called personal finance. And one of the things that was actually brought home to me on Monday is while when I talk about these issues in the UK, what I mean by personal finance is the business of long-term consumption planning. It's the mechanisms by which people fund their education when they're young, by which they save for retirement when they're old, and in which, in between, they actually manage their finances to make these things possible. And people need both institutions and advice in managing these processes. What I realized when I talked to the savings group on Monday was the extent to which the issues of personal finance in Kenya are for many people much, much shorter term than that. They may be the people who borrow money in the morning to buy stock to sell in the course of the day. People who are literally managing their finances on that day-to-day basis. But the problems that these savings groups and other small loan mechanisms exist to solve are much more short-term problems of personal finance. But they still fall into the same category of enabling people to smooth their consumption over periods of time. The third function of finance is capital allocation, taking household savings and directing them into productive investment. Now, in Kenya, as is also true in Britain, the main need for that process of capital allocation is actually in the SME sector. The truth is, large companies in the world today are essentially self-financing. The capital allocation process for Britain is about SMEs. And in the book Other People's Money, I asked myself, what are some examples from around the world of where this business of SME financing is actually done well? Because, to be honest, there are not very many where it's done well. There's the one we're all familiar with, which is Silicon Valley in the United States. There's the German Mittelstand, in which finances medium-sized businesses that are the powerhouse of German manufacturing and Germany's export success. There's the high-tech sector in Israel, which has developed in that country a group of competitive firms that are actually world-leading in what it is they do. These come from wildly different environments, wildly different cultures, and wildly different political backgrounds. But what they all have in common is that they are fundamentally personal and they are fundamentally local. That is intrinsic to the nature of SME finance. It's something that depends on local knowledge, on personal knowledge, and that's something which computerized algorithms may be able to help, but they certainly can't replace that kind of knowledge. And the final area in which we want finance to help us is to do with risk allocation, to help us mitigate the risks which people face in ordinary life. And I want to say a little bit more about that history and process of using the financial system to manage risks. Because if you asked people in the financial sector what has been the main value of financial innovation, of the process of financialization over that 40-year period, risk allocation, risk management would come top of their list. My thinking about that issue starts from a book I read way back in the 1990s, contrasting Anglo-American and continental European models of capitalism. A book by a French economist called Michel Albert, who became chief executive of a large French insurance company. And he talked about the two origins of the global insurance sector. One, next please. One was this, it was Lloyd's of London, Lloyd's coffee shop in the late 17th century, was a place where English gentlemen would congregate basically in order to talk and above all in order to gamble. They would gamble on the weather, they would gamble on the tides, they would gamble on the fate of ships at sea, they would gamble on the health of the king. But actually trading merchants in London realized that they could use this gambling establishment to lay off some of the risks that were associated with trading overseas. In due course, that metamorphosed into the Lloyd's of London insurance market, which is even today, 400 years later, a center of the world, the center of marine insurance for around the world. The second source of the world insurance industry came, Albert suggested, from Switzerland, where at about the same time, Swiss villagers would gather together to try and mutualize the risks which are involved in their rather harsh everyday lives. when I talk about it to an audience in the UK, I say they would agree that if one of their cows died, the rest of the village would gather together to buy another. That has a particular resonance for me in Kenya now, and I'll come back to that a bit later. But these twin aspects, the mutualization of the risks of business and everyday economic life, and the gambling in which people take different views about what the outcome of a particular event is going to be, were the origins of the whole set of risk markets we have, and the whole set of risk markets which grew explosively in the period from the 1970s to today. And these risk markets had throughout this twin aspect to them of mutualization of risk on the one hand and the gambling motive on the other. Now that became, was something that became an issue at what is now a notorious conference, which was held in Jackson Hole in the United States in 2005. The Federal Reserve Bank of Kansas every year organizes a symposium. It happens in August. It happens in Jackson Hole, which is an extremely beautiful ski resort in the Teton Mountains in Wyoming. And because bankers are not very busy in August, and because it is a very beautiful place, they have been successful year after year in attracting people from around the world to go and talk at Jackson Hole. And no, can we go back, please? No? No. The 2005 conference was a especially memorable one. You can see they called it the Greenspan Era Lessons for the Future. Its purpose was to celebrate the 20-year tenure of Alan Greenspan as chairman of the Federal Reserve Board, which was coming to an end in 2006. Now, there was one person who went to that event determined to spoil the party. He's the man on the right. His name is Raghu Rajan, and he was then chief economist at the IMF. And Rajan said that what was happening in the financial system was that people were taking on a lot of what are called long-tail risks. That is, risks with a low probability of substantial loss, and the likely outcome of this at some time was some kind of widespread financial collapse. You probably won't be surprised to hear that Rajan's paper was not very well received. The discussant of the paper, Don Cohn, said that Rajan had completely misunderstood what was going on, and what was happening was the diversification and spreading of risks in a way that made the financial system much more resilient and robust. He was joined in his denunciation by Ben Bernanke and Tim Geithner, the two people you see in the middle. Bernanke was then a Fed governor. Geithner was chairman of the Fed Reserve Bank at New York, and most vehemently by Larry Summers, of whom many of you will have heard, who described Rajan's views as Luddite and said he wanted to take finance back to the era of coaches and horses. When I tell the students this story, the first lesson I draw for them is what I call the unimportance of being right. It's perfectly clear in retrospect who had made the correct call on that particular occasion, but it didn't prove any obstacle to the further advancement of people who took a different view. Bernanke became chairman of the Fed in succession to Greenspan. Don Cohn, the discussant, was appointed his deputy. Tim Geithner became Treasury Secretary in the Obama administration, and Summers became Obama's chief economic advisor. Rajan, on the other hand, was pushed out of his job at the IMF. In the first instance, he didn't do badly out of that. He went back to India, where in due course he became governor of the Reserve Bank of India. But it turns out that talking truth to power doesn't go down any better in Delhi than it does in Jackson Hole, and Rajan has now moved on from that particular position. As I tell my students, it is much more important if you're going to get on in life to be conventionally wrong than to be unconventionally right, as Keynes put it more than half a century ago. It's clear that the people at Jackson Hole had fundamentally misunderstood, perhaps willfully, the nature of what was going on in the financial system. Not everyone, however, had. Next one, please. This is a man called Fab Touré. We'll come back to his work in a moment. But those of you who've seen the movie The Big Short, and I imagine that is many of you in this room, will know that Touré was involved in what was called the Abacus transaction, which was the biggest single group of deals in relation to shorting the subprime mortgage market in the United States. And this is Touré in the terms in which he described what he was doing to his girlfriend. I had some input into the creation of the project, this product, which, by the way, is a product of pure intellectual masturbation, the type of thing which you invent telling yourself, well, what if we created a thing which has no purpose, which is absolutely conceptual, and nobody knows how to price. That wasn't the language you might anticipate in which he described the product to Goldman clients. And of course, we all know what the outcome of that particular transaction happened to be. But actually, as the bankers were flying home from Jackson Hole, something very significant was happening in a quite different part of the United States. It was, next please, this. Hurricane Katrina was blowing into New Orleans. It killed 1,500 people. It was the largest single cause of insurance losses in the world to date. So the second mistake that people at Jackson Hole were making was, first of all, they thought they were in a Swiss village, when actually they were in Lloyd's gambling coffee house. But the second mistake was that the risks they were talking about mitigating were not the risks that concern ordinary people at all. They're the risks of everyday life, the risks like these. The risks that were being talked about at Jackson Hole were the risks to do with foreign exchange fluctuations, to do with equity market crises, to do with interest rate movements and the like. They were all risks that had been created within the financial system itself in the first place. So let's go back to cows for a moment. I regarded, when I talked about it in Britain, it as being something of a joke to say that Swiss villagers got together to mitigate the risk of one of their cows dying. But actually I talked to these smallholders, two smallholders, each of whom had 2 cows, and each of whom were trying to save. And they explained to me that if they succeeded in saving the amounts they hoped to save, what they hoped to do was to start some sort of development on their small holding that would enable them to invest in real estate. And I asked, so why wouldn't you expand your agricultural business? Why wouldn't you get a 3rd cow? And they pointed out that it was risky to have a 3rd cow. A cow might become ill, a cow might die. Actually, they had precisely the same needs that these Swiss villagers had 3 centuries ago. And also, they weren't finding financial institutions to meet these needs. I talked again about that at a meeting yesterday morning with some people in the financial services business here in Nairobi, one of whom from an insurance company explained that his company had tried to offer that kind of insurance, but it hadn't been very successful, because typically they weren't at all sure whether the cow had actually died or would reappear in a healthy state sometime later. And of course, when one thinks about it, that's right. The mutualization within the village was effective because you could not scam a group of villagers who knew what was going on and with whom you were going to have to live for the rest of your life. But the village acquiescing in a scam which was perpetrated on some rich anonymous insurance company in Nairobi was another matter altogether. This kind of insurance works and can only work if it's done at that kind of local level. So, what does all this mean for what we ought to be doing? Presumptively, I want to try and pull out some lessons for Kenya from what it is we've said. And the first comes from the description I've just been through of the insurance or the non-insurance for the cow. It is that the development of finance is something that is fundamentally local and personal. That's how insurance as risk mutualization comes into being. It's also how SME finance is done effectively. It's also how personal finance was being done in the savings group. And until very recently, it has been the major transformation that has happened in this country and in many other places. Finance in terms of the payment system had to be personal as well, because you simply couldn't make cash transactions at a distance very easily at all. That is one thing that has changed. But the essential things have not changed. That effective provision of finance depends on knowledge and information and on being embedded in a social context in which trust is available to support financial relationships. And that's why the person at CNBC who thought that what finance was for or what financial inclusion was for was to enable people to sell financial products of a kind that had been devised in Western economies to a much wider group of people. That's why he had so much missed the point. He had missed the point just as much as the young Republican staffers who flew in just behind the American troops which took over Baghdad to establish the Iraqi stock exchange. A stock exchange was not the first thing Iraqis needed after the invasion and the toppling of Saddam had taken place. SME finance, risk management and the like, personal finance has to be done at a local level. Let me end with a few words, because I can't give a talk like this without people asking questions about regulation, which I want some of which I want to anticipate. When I do give talks like this to a general audience, I make the fundamental point that we in the West, certainly in Britain and the United States, today have a financial sector that has lost sight of its underlying purposes, that has lost sight of the objectives of providing a payments utility, of helping people manage their personal finances, of achieving efficient capital allocation, of helping people to manage the risks of everyday life. We have a financial system which in this sense has lost sight of its core purposes. And the very immediate question is, isn't that a fault of regulation? Wasn't the problem created by the fact that we deregulated the financial system? Well, here are a couple of slides, if we can have them. This is the number of pages in US bank regulatory filings. And this one, next please. The next one will be another measure of the volume of financial regulation. But I have to say, when you look like graphs like this, it doesn't feel like deregulation to me. Actually, over the era of financialization, the regulation of finance has increased by the same orders of magnitude as activity has increased in the financial sector. The problem is not, in my view, that we don't have enough regulation. The problem, in my view, is that we have the wrong kinds of regulation. We can regulate, broadly speaking, in two kinds of ways. We can regulate industry by regulating its structure and the incentives of people who operate in it, or we can regulate it by laying down lots of rules about how people in the finance sector are supposed to behave. And over the past 40 years, the way in which we've directed regulation has been to the second of these. We've laid down more and more rules of various kinds. And that has produced the regulatory regimes which we have today, which I believe in the West are both very extensive and intrusive, and yet are largely ineffective and are subject to what is called regulatory capture. That is, their form is over-influenced by vested interests of people in the industry. I think we need to move back to a form of regulation that emphasizes the structure of the industry and the incentives of people within it. I think we made mistakes in terms of the structure of the industry in allowing very large financial conglomerates to emerge, ridden by conflicts of interest. And I think if we can have a chance of getting the next slide but one. How's it going back there? That's another measure of the extent of regulation. Can we move to the next one? Yep. This is, you heard earlier from Fab Touré, who was selling products in the Abacus transaction. This is his bosses being asked to explain that transaction to a Senate committee in 2010. Can we have the sound, please? It's worth it if we can get hold of it.
But did the firm expect... But did the firm expect you to act in the best interest? But did the firm expect you to act in the best interest of your clients?
I believe we have a duty to serve our clients well.
I guess, Mr. Chairman, that I'm not going to get an answer to my question any more than you did with yours.
What's missing in that slide is any real sense of personal responsibility. And it's the issue of personal responsibility that goes to the heart of developing trust in a financial services system. I described earlier how HBOS and the Royal Bank of Scotland, the organisations that some of my classmates joined in the early 1970s, how they had I described HBOS and RBS as they were. As I said, HBOS and RBS both went bust towards the end of 2008. Scotland has actually been a pioneer in banking right from the beginning. And the last bank which went bust in Scotland was actually the City of Glasgow Bank in 1879. There was one big difference in the aftermath of that, which was that in 1879, within less than 3 months of that bank going bust, all the directors of the City of Glasgow Bank were in prison. That is rather different from what happened in 2008. And to see how much we need this driving home of personal responsibility to the people who run these organizations, let's look at this next slide if we can. This is more from the same hearing about the Abacus transaction.
And when you heard that your employees in these emails, when looking at these deals, said, God, what a shitty deal. God, what a piece of crap. When you hear your own employees or read about those in the emails, do you feel anything?
I think that's very unfortunate to have on email.
Are you embarrassed?
And very unfortunate, I don't...
On emails,
please don't take that
how
the wrong
about
way.
feeling that way?
I think it's very unfortunate for anyone to have said that in any form.
How about to believe that and sell it?
I think that's unfortunate as well.
I think if there's one central fact of financial services regulation, which is key to the development at the early stages of an integrated, successful financial system, it is the assumption of personal responsibility, the recognition of that all the money that is in the system is other people's money, and an understanding on the part of both the public and the people who work in these institutions of the awesome responsibility that actually goes with that. There's only one video which I found which rivals that exchange between Vineyard and the Senate committee in its grotesque nature, and that is this one. I hope we can make it work.
Everybody is to leave here immediately. This cafe is closed until further notice. Clear the room at once. How can he close me up? On what ground? I'm shocked to find that gambling is going on in here. You're winning, sir. Oh, thank you very much. Everybody out at once.
I'm sure I don't have to spell out the message. Thank you all.
Thank you very much indeed, Professor Kay. Notwithstanding the technology, I think that was one of the most illuminating lectures I've heard in a very long time. Can I now turn across to our governor, who I think needs no further introduction. Dr. Patrick Njoroge has been governor of the central bank for the last, I think, nearly 2 years and is certainly a major public figure now in Kenya. So let me not tarry any further and ask Dr. Njoroge to respond.
I'm so delighted to be here. This is the second time I'm the respondent to the annual lecture, and definitely being the respondent to John Kay's lecture is an honor and definitely gives me great pleasure. This is the third time I'm hearing this lecture in the last 2 days, and I have to tell you that I would go for a fourth time as well. It's quite illuminating. I do have 2 copies of the book, by the way. I may auction one of the books because I'm not going to read both. But one of my copies has actually ran up a lot of frequent flyer miles because I've been taking it with me. It's not bedside reading, by the way, but it's been very good. It is actually quite enlightening, and frankly, if I had to, in some sense, explain or try and tease out the main points of it, I would really be at a loss. I would actually say that it's the only, well, there's a book that, another book that you all know, and I'll just quote something from that book that you all know. I still won't tell you what book it is, but I'm sure all of you know it. And it goes something like this. I think this applies to John Kay's book as well. And it goes something like, the composition of this book has been for the author a long struggle of escape. And so must the reading of it, be for most readers if the author's assault upon them is to be successful. A struggle of escape from habitual modes of thought and expression. The ideas which are here, expressed so laboriously, are extremely simple and should be obvious. The difficulty lies not in the new ideas, but in escaping from the old ones, which ramify for those brought up in, like most of us, they ramify into every corner of our minds. John, I challenge you. Which book is that? Yes, it is that one. John Keynes' General Theory. That's the part of the foreword of John Keynes' General Theory. Obviously, one of our favorite books. I don't want to go into the dissecting the lecture, which I think deserves a lot more than just dissecting. I thought I would just give a different, not different set of facts, different spin, let's say, on things that are happening in Kenya. Really more issues on the financial inclusion side. I think in terms of the specifics that John has raised, I think we can have a more robust conversation. It's much more interesting that way. But I thought I would spend maybe 7-10 minutes max going over some issues that I think are more germane to the financial inclusion agenda. We could relate it to what John has said, but it's probably, in the interest of time, it's probably better just to plow right ahead, and then we could discuss it in the Q&As. Obviously, in Kenya, we've seen a substantial change in the way in financial inclusion, really through the digital platforms that we have. We know about the mobile phone technologies that we now all have, like something in the order of 38 million phones out there in Kenya. And we know about the success in terms of reducing the financial exclusion, increasing financial inclusion to 75.3% currently from something in the order of 25% back in 2007. And these sort of improvements or successes in financial inclusion have been replayed or have been reproduced elsewhere. So Kenya is no exception. Around Africa and indeed also somewhat around the world. It's interesting that other developed nations have not quite, I mean, the US is at 81%, no, actually it's not at 81%, but we know that it has not really kept up in terms of using the technologies that we have. Of course, they have a lot more banks and things like that. Anyway, this marks an important, it marks important success on our part. From my perspective, or from our perspective, really, we can look back at various changes that led to substantial improvements in the poverty reduction in terms of social outcomes. And actually, the one item that comes to mind clearly, I guess to all of us, is the improvement or rather the reduction in extreme poverty that has taken place or took place, say, from 1990 to 2010. We know around that time about 1 billion people were lifted out of extreme poverty, and China contributed, as you know, something like 3/4 of that. And if you go again to a little farther, you can look at the agricultural revolution of China and appreciate, well, we are watching the movie now, and appreciate the improvement in, or the benefit of the agricultural revolution in China in terms of improvement in poverty indicators and so forth. Really, this is what we are about to see in Africa. This is what we are about to see in the world. The possibilities of the numbers that we are talking about, improvements in financial inclusion, have the potential of bringing down or lifting a lot more people out of poverty, akin to the successes that we have seen in the past that I just now mentioned. Now, the numbers that I just mentioned are financial inclusion numbers. Really, from our perspective, you could say that they are the rails, okay? So we have the rails, but what are we gonna put on it? Well, the first thing is to note that we still have 25% of population excluded from the financial system. And that means that we have some ways to go. It's true we have hit diminishing, you could say we've hit diminishing returns, but 25% of the population is a substantial number. So I think there's still some ways to go. It's not, we cannot just say we'll switch to other products or whatever else it is. But still we have to improve, we have to put more trains on the rails. Before getting into what other products can we put up and all that, I think it is important to sort of point at some things that maybe would help improve financial inclusion. And the first one is the having more reliable and cheaper devices. It is important, I mean, from my perspective at least, the number one constraint to improvement in digital financial inclusion and digital finance is really the unreliable telecom systems that we may have. I mean, you could think of yourself making a transaction, right? A financial transaction, and suddenly the thing hangs up. If it's a phone call, it doesn't matter, you call again. But if you're making a financial transaction, you don't know whether it went in or not, you know? So it's a real concern. It looks like a small thing, but this is a significant constraint in the end. So more reliable networks, cheaper services and things like that. Those obviously are a whole set of things that we could discuss. Then, of course, there's the issue of spanning. It's true, we talk a lot about M-Pesa this, M-Pesa that, but I think the point here is, can we span the commodity space, or can we span the services space? Meaning, yes, we do have M-Pesa and others. We do have other services. Can we make progress in terms of using those services for even more things? The point is that the technology is there. Just the other day, I was involved in, as governor, you're shown these things, boxes, right? IT people and all that. And the last time it was KBA. So they were showing me their new product, shiny, really nice. And it is what, the Pesa Link? And apparently they're going to unveil it in a few days. And so they were showing it to me and so forth. But I guess the point is the idea behind it is not very difficult, but it's actually a straightforward idea. But I think the point of the convenience of it and the impact that it will have, it will kind of, as far as I can tell, it will make debit cards sort of passé. Nobody will ever need a debit card if you can use this in particular ways. Anyway, I'm advertising for your product, but I actually challenged them on something else. Sorry to deviate on this. The transactions were, they told me that it would take, 45 seconds. I said, 45 seconds? Why 45 seconds? And so in the end, it came down to 22 seconds. So we are making our way to the 7 milliseconds, but we are not there yet. We are at 22 seconds. I want to move on to other things. Professor Kay talked about SMEs. So in this point of expanding the space or spanning the space, SMEs, yes, that's true, but I think there are other things. Micro insurance is a big one. There's a lot that can be done, and I think you talked about it in the context of the risk insurance or risk management. And you think about farmers, you think of other people. I mean, most of us in this room probably have medical insurance and other insurance. But there are a lot of people out there that really need this particular service. And somehow we need to get the, let's say, the entrepreneurs on this job, where is the need? Let's go after those needs, not just some theoretical construct like the ones that were John Kay showed us a moment ago. A few other points before I finish. It's interesting, looking at Kenya's data, the gender bias. Okay, so in terms of men, women, it's interesting that Kenya has actually very good, let's say, data, well, very good statistics in this regard. The balance here, the gender balance, is something like 7%, meaning the difference between men and women. So there's a 7% gap in the 100, if you see what I'm saying. As opposed to some countries like Niger, where it's 41%, and other places. So it's closer to sort of more developed. Actually, the average for low and medium income countries is 14%. So it has a much better outcome in this regard. But the interesting thing for me was we were looking at some data, our staff were looking at some data on Kenyan data on a large platform. I'm not going to say what it is, but you can, anyway, large platform. And it's interesting that 41% of the users of that program, of that platform, are women. Okay, so 41%. Actually, 99% of these women are active users, as opposed to men, where it's only 77%. So women not only have access, they're actually using it. Okay, here's the clincher for me. Actually, women accounts, or rather women account for 82% of total savings in this platform. Just think of that. 82% of the savings there are from women. Now, I was thinking of something else, another statistic that was thrown at us maybe yesterday, which is 35% of the microloans, the loans like on Mshwari or whatever, you 3,000 shillings or whatever, 35% of those loans actually are provided between 3 a.m. and 5 a.m. It's true. And so if 82% of them are women, then Kenyan women are really insomniacs, right? But I say this not only to laugh about it, but I think the point here is that you know why this has a significant impact on poverty. Because the ladies that are borrowing through these platforms are actually going to the store, or rather going to Marigiti and other places, buying the vegetables, and at 7 o'clock they're at the intersection and all that. I was told also that they do more than that, that they will make their payments on online, or rather on their phones. They'll also call it's not the Dudi guy, it's the guy on the Mkokoteni, and sort of tell him to pick up those things and deliver them on a particular, all of that done on the phone. So it's amazing how this is making a difference. I want to finish. I think the point I would make is that all these changes are transformational. And there are many others that are coming up. But I think the point here is we at the moment, we're at an interesting time where on the one hand, there's a lot of concern around the world about inequality and the lack of connection of a huge swath of our population with globalization. Digital financial services, more generally speaking, will help us make a difference or improve in terms of globalization and indeed in terms of poverty statistics, reducing those numbers. So I think it's for us to sort of appreciate that, yes, we are at a time when we can really make a leap forward in terms of the democratization of financial services. I'm not sure that it will be as glamorous as maybe in the movies that, or the clips that you showed us, but at the end of the day, we know we will make a difference in terms of poverty, which I thought was the first point you made, which is we really need to be on the right side of history, which is in terms of reducing the levels of poverty and improving the welfare of our population. Thank you very much. Thank you, John. Sure.
Thank you very much indeed, Dr. Deroge. It was slightly heartening to remember that we have choices here, that there is a virtuous path as well as what seems to me at least a path that we would wish to avoid if at all possible, that Professor Kay was illuminating. Let me not say any more. Let's throw it open now to a discussion. I think it would be very helpful if, when you ask your question or make your point, if you could perhaps just very briefly introduce yourself. That would be helpful. But the floor is yours. Lady in the middle.
My name is Jordan Corcoran. Hi. My name is Jordan Corcoran. I work with a Kenyan company. It's called 4G Capital. We provide unsecured working capital loans to market traders instantly via M-Pesa. And I was wondering your thoughts on where the non-deposit credit and fintech space will be developing the fastest in Kenya and in similar markets.
I wish I knew the answers to questions like that. I don't know the answer to your question for two reasons. One of which is I don't know enough about Kenya and the way a business like yours operates. But secondly, I've become very bored in the last couple of years with people talking in generic terms about fintech. You know, I'm quite sure that this industry is going to go through massive phases of disruption from information technology in the next decade or two. But when I'll ask people who are interested in fintech to explain to me how what they are interested in will actually meet better my financial needs, far less the financial needs of the kind of people whom I met on Monday in the savings group and the small holdings. I find very few answers. That I feel a lot of fintech at the moment is a set of solutions in search of problems. And it's really only when we actually focus on meeting user needs that we will develop technology of the kind that is actually going to advance the causes which are important to all of us. I think it is kind of so obvious that Apple's extraordinary success is based not on whizzy technology, but on rather good technology, packaged in a way that makes it very easy to use and usable by people who are not in the least interested in the underlying technology. That is such a powerful business lesson that I cannot understand how many people continue to miss it.
I don't have an answer either, so that's, we are even. But just one thought. I would completely agree with John that it is important that there is a problem. So whatever it is, it should be a solution to a real problem. And there are many problems out there, many problems. And all we have to do is to be patient in solving those problems. And I think the second element is also an important one. And I think a lot of, some of us, and I have friends in this area, and they're very impatient. And the moment they have a little widget, whatever it is, you know, they want to spin and tell us all there is in terms of this will be the solution for everything. And in a sense, they are not patient enough to to figure out what is the problem, or for that matter, how will it work, into the long term. So, and then what happens is it has an advantage for a period of time, and in a few months, somebody else comes and it's completely blown out of the water by some other technology. So it's something of, it's a lesson in patience as well, but I think also a lesson in humility. But in terms of the specific, we as the regulator obviously cannot point the way in this regard. We regulate, we don't, we do more than regulate, but I think we don't have comparative advantage to know what is the next best thing.
Hello, my name is Leanne Al-Hur, and I'm a project manager on digital financial inclusion projects at Georgetown University's office here in Nairobi. And Professor K, you touched on information asymmetry in the credit market or the insurance market in your lecture. And a lot of the excitement that's happening here in Kenya on digital financial inclusion is that platforms such as M-Pesa are building digital records that can be used towards building credit history for people and the credit score based on which they can get loans. Now there is a move to automate this scoring from personal to machine learning, and so that it's done through machines all the way. How dangerous do you think that is within the Kenyan economy, especially on the very small individuals, given that the loans are maybe a maximum of $100? And to the governor, whether there are any current regulations on such issues and on credit scoring for the low-income people. Thank you.
It's an interesting question to what extent the sharing of information within communities and social groups, which has been the mainstay of effective financial provision for the last two centuries or so. To what extent does the ability to provide, to assemble these extraordinary databases change that? I think the answer to that is we don't know. We learned an early lesson, which was that the kind of belief that you could turn even quite large loans into homogeneous securitized products through credit scoring and algorithmic decision making actually worked out very badly in the run-up to 2008. So we've had one set of bad experiences in this. I think the general lesson we've been learning is that you can have computer algorithms that will do better diagnoses than many doctors. You also have doctors who can do better diagnoses than computers on many occasions. And a doctor and a computer in the hands of a skilled practitioner is probably going to be much better than either. So I think that the bottom line is that these things are going to be aids, not substitutes.
On the Kenya-specific question, or angle to your question, actually, for us, it's interesting that the microloans, this is one of the beauty of the microloans, that the ladies that I was talking about, the fruit seller, or mama mboga as we call them, when they borrow this 3,000, they are building a credit history. And that's really something that is beneficial for them in the long run. Tomorrow they can borrow more just because they have had an entire week, or should we say an entire month or an entire year of good credit history. So it is actually happening. And I would say actually our credit companies, the credit scoring companies, they are using algorithms to do this. So maybe they haven't, and they're still polishing those algorithms. It takes a while to really calibrate these things correctly, but they're making progress. So we believe that we are going in the right direction, and it's only a matter of time that we can sort of say, well, okay, the information is being used positively for the borrower. Of course, there's the other side of it, which is we have to have it has to be secure. At the end of the day, it is their information. information, it's owned by it's personal information. So privacy concerns are major, but that's part of the deal.
Hello. If I may add one point to that, I think perhaps one of the more exciting elements of this, obviously there's a reduction of risk which will increase credit flows, but it's a thought that we might be able to tailor solutions that actually make sense for people, so that we're not in the world that Professor Kay was talking about, of trying to sell people products that they didn't understand and didn't suit them, that we could actually use better, denser information and insights in order for financial institutions to provide people with real-world financial solutions rather than the things that they think they want.
Hello, yes. My name is Mark Ambito. Working for a company called Mobile for Good Solutions, which deal with mobile apps, especially for M-Learning and M-Agriculture and M-Health. My question is basically directed to Professor Njoroge. Professor Kay has said basically well about the potential of the SME. Looking at the opportunities that lie in the SME, a survey has been done to say that in the next coming decade, a lot of jobs that China is holding, especially in the textile industry and the middle jobs, are going to be shifted to Africa. More likely, China is going to go a little bit higher to compete with countries like the US. The potential is enormous. But just apart from giving people loans, this SME sector that holds a big potential lacks technology. The government is not putting enough in putting institutions that can train these people in technology, like in the leather sector, in the textile industry, and most likely in the engineering industry, like what India and China has done. What is the professor doing to put this point to the government so that people get the required technology? Because it's no need giving people money while they can't compete with these companies from China or from India. Thank you.
Thank you. Maybe to underscore what you said, the SME sector will have the lion's share in terms of job creation in Kenya, or at least that's the expectation, and even now, in terms of jobs. But in terms of job creation looking forward, yes, this is the sector that we believe we will have the most jobs. But I think there is another angle to it, which is the entrepreneurs, the owners. So it isn't just capital, as you said. You correctly noted that. It's also know-how, technology, but also the entrepreneurs, the person who owns it and wants to, I don't know, make whatever widgets that are needed. So I think the point is it's a complicated it's a complicated sum of many inputs. And I think here is where we do not have the single key to resolve the matter. Now, I know that there's been a lot of interest in the SME sector, a lot of interest. As a matter of fact, the World Bank just recently, I think it's the World Bank, just recently produced a book on SMEs. It may be the KNBS, I'm not sure now which of the two. It's on my desk and I don't remember who wrote it. But the point still is that let's not expect a sort of a single solution. So the silver bullet that resolves the issue. It'll have to be a combination of things. We'll do our part. We want to do our part. The banks, for instance, have already, they're already walking this path, down this path in terms of providing capital. But a key element is it has to be capital and also other things. For instance, markets. You talked about the know-how to build things, but it isn't just that, it's also markets. One of the interesting things looking at, say, the last 20 years of China's development, you know, as you said, China did have particular, let's say, it was producing certain things, products, widgets, whatever. And then you have this sort of supply chain which has moved south to Southeast Asia. So it's moved down to, I don't remember the geography now, but you have the Thailands and so forth, all the way down. So we will see a similar thing if we are ready for it. And I think here's where I would say, well, let's all play our part. Let's all play our part and be ready for it. It won't just be one item. Thank you.
Gentleman on the left, I think, has been waiting. Oh.
Okay, thank you. Thank you very much. My name is Samson Munene. I work with Centum Investment. My question is on inclusion in the capital markets and specifically in the money markets. We understand that this is a sector that is really a preserve of institutional investors and sophisticated investors. So to the governor, what are some of the measures that the government is putting in place to enhance more inclusivity, of more people to participate in especially in the money markets? And to Professor, what is the world practice, especially in terms of opening up capital markets and money markets to more people and not making them a preserve of sophisticated and institutional investors? Thank you.
Perhaps we should start with Professor Kay on that broader question.
Yes, because there is a very broad question in that, which is to what extent the future lies in market-based finance. I'm asking that question, I don't mean that I want a world of nationalized banks and state institutions providing capital. What I do mean is that the high volumes of trading in securities, which I talked about at the beginning of what I had to say, I think we need to ask questions about whether these are actually adding value in terms of the underlying needs of users. I raise that particularly in relation to public equity markets, which I think, as far as countries like Britain and the United States are concerned, are essentially phenomena appropriate to the kind of large manufacturing corporations that dominated business in the 20th century, but will not dominate it in the 21st. So I think it is back to where we want to review the world of CNBC very carefully before we decide that we want to be there.
The specific example I would give is the Emma Kiber and T-Direct, I think that's what it's called. This is a platform, or this is a set of platforms that I think we've talked about in the past. But just for everyone's sake, the Emma Kiber platform is supposed to be a way to sell securities, government securities, to the masses. So democratization of the purchase of government securities. And the idea here is that you can purchase it on your mobile device for as little as the equivalent of $30 US, okay? And you could think of what this means. You could think of that person who only earns, let's say, 500 shillings a day and saves 100 shillings. So at the end of the month, he has enough to actually make a purchase of his savings through his mobile device. The point is that this will open a huge avenue for savings, huge avenue for savings. You know how people save now. You save in your plot, whatever it is, the 100 by 10 or 100 by 50, I think those are the dimensions, all under the mattress or whatever else it is. And you can think about the number of people who are in this sort of income category, the Caspers, people who are earning, say, $5 a day or something like that, 500 shillings a day. So I think this will be transformational. I really think it has a lot of potential to transform savings as we know it. Of course, there are challenges, and this is why this thing has taken so long to get it out, get it into the prime time. Because there are risks in there. You can imagine if you want to, for instance, you want the purchaser, the investor. I mean, these are people who are very poor, But you want them to reverse out of it in a case of need. You understand what I'm saying? Now, for me or you, all I have to do is to wait until Monday when I don't know, when Centum opens or wherever else, my investment banker opens, and I tell him, look, could you please liquidate X amount and so forth? And I know by lunchtime I have the cash. But the category of citizens that we are looking at, or the population, they won't have that luxury. But you do want them to exit or liquidate in a particular, so you do need to have a pool and so forth. I'm just giving you a sense of the complexity of just a very simple idea really has to be fixed in order to release it. And that's why it has actually taken so long. There has been questions as to, whoa, another delay of Emma Kibber. And frankly, I would rather it gets delayed until it comes out right, rather than having it out and then we have problems in terms, other problems, whatever it is, like we were having on the screen today. So there it is. But I think there are many other options. I talked about micro-insurance. But I think this have yet, well, it is in other jurisdictions, so I hope that it will be brought here soon. But there are many other things like this. I really think the limit here is our own ingenuity. So the challenge is back to you.
Thank you. And then I'm afraid it's going to be our final question. We are coming to the end of our time. The gentleman who's been waiting.
Thank you very much. Very good evening, everyone. Thank you for graciously hosting us, FSD Kenya. Truly appreciate it. My name is DJ Kuman. As you can see, a Mlami hustler, just trying to make a coin like everyone else. I run a small startup here in Kenya providing affordable internet access to low-income areas such as urban slums and rural communities. This question is more directed to Mr. Joroga than to Mr. Kay, I'm afraid. How will you ensure that we don't follow the Anglo-American path of disaster, whilst at the same time we're all promoting the perversity of microloans with an APR of well above 50%? We're punishing the people that live hand to mouth by having hefty transaction fees on small payments P2P. And we're not doing enough about, say, promoting insurance products, micro-insurance products, rather than all the loan products, because loan products are poison. Mshwari, Easy Loan, they're the electronic loan sharks of this world.
So a nice, straightforward question to end with. Dr. Joroga.
I want to push it to John.
I think the job of dealing with the loan sharks is the governor's, not mine.
Yeah. Wow. I clearly feel your sentiments. This is something that maybe it takes me back to another story, which I was thinking about when you were telling us all these things about bankers. But in any event, the point is that we really do feel your concerns, and we need to address them. We have started. We've made a start at this, and I think the point here is that we need to encourage the bankers to take other steps. If you recall some time ago, I did make the point that the bankers need to do the right thing. They need to provide a down payment and all those other things, meaning they need to change the way they look at business. I think that's a lesson that has come in every single crisis out there, and I'm now speaking like an economist, having looked at this in, like yourself, other parts of the world, and so forth. Every single crisis, at the end of it, there's always a sort of a mea culpa, and we need to do the right thing. And there's a sense that, yeah, we need to take these steps, whatever it is. It's no different in Kenya. It's true, the bankers now want to do the right thing. But it's not sufficient for them to just do that. We as the regulator need to work with them, meaning to push them to actually achieve the targets that you just pointed out. It's true, the APR may be very high. You're absolutely right about that. And we need to work with them to make sure that it actually comes down to a much more appropriate level. It's not just the APR. It's also things relating to the security of the loan and so forth. There are many other things that one could think about. So I think all I can say is we hear your concerns. I would also hope that you'd agree that we have been challenging them in terms of what they need to do. I'm really seized by this thing of expanding the set of products, but in a sort of a, let's say, in an organized fashion, meaning it shouldn't be like a cancerous growth. It should be something that is much more generic. And you talked about insurance, for instance, which is a big one. You think of health insurance. This is a single, I mean, all the things we've been reading in the newspapers recently. I'm sure all of us in this room know people who have been in hospital, and the moment they're in hospital, what everyone does is to go on Harambe. And it isn't that we don't have the income to deal with that, but somehow the insurance sector doesn't quite help us as we wanted to be helped, us to be helped. Now, we can talk about it, we in this room, but what about the other masses of people who are not as sophisticated as the people in this room? So I think the problem is much deeper in that sense. And I personally don't distinguish I don't know where the boundaries are in terms of financial sector. And I say this as an economist. Yes, I know there's the banking sector. Yes, I know there's the insurance sector. Yes, I know there are capital markets. But you know, these are all part of the financial sector, generally speaking. And they're all providing the four services that John presented. So I think there's a lot of work to be done. But on the other hand, I think we're in the right place. We have the most innovative people in Kenya. We have, young, innovative. We just had a few descriptions of what they're doing. So I think there's also interest on our part. I think let's give it some time. Let's give it some time, and let's watch what they're going to provide us for us to regulate.
Thank you very much indeed. It's with regret that I must now draw this session to a close, and it really just remains for me to offer my profound thanks to Professor Kay and to Dr. Njoroge. I think they have both fulfilled in bucketfuls the aims of this lecture series, which is to provoke debate and thought about where we should be going with the financial sector in the future and what financial inclusion should mean for Kenyans. And thank you all for coming tonight, and I look forward to seeing you again at our next lecture. Thank you. And a big round of applause for Professor Kay and Dr. Njoroge.